Hello, everyone. Today on the final bar, I'm joined by Peter Brandt, founder of Factor LLC. Peter's going to share with us some big picture charts talking about the overall market environment. The S&P flat, sort of chopping ground, sold off in the morning, but sort of recovered through for the most part. Plenty of movements out there, though, outside of the S&P. And what we'll focus on is where the opportunistic moves are. For example, mid caps and small caps both down while the S&P flat. What does this mean big picture? We'll answer it together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we debrief on the activity of the day using the power of stock charts, using the lens of technical analysis, behavioral finance. And as we've talked about many times on the show, your goal, I would argue, as an investor, three things. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are exhausted. And what's interesting right now is you have this sort of, this situation where based on trend, based on breadth, arguably the conditions have never been better. You have a consistent uptrend. You have breadth overall that has been very supportive, although we've seen some question marks bubble up on things like the bullish percent index, like we talked about on the show yesterday. But on the same time, that third piece is anticipating when trends are exhausted. And I'm seeing things like bearish divergences. I'm seeing things like sentiment at euphoric levels, arguably. And those are more, characteristic of later stage bull markets, not early stage bull markets. So, it's an interesting situation. It's in the, getting halfway through the first quarter when many, including me, suggested we would have a meaningful pullback. So at the end of the day, though, it remains to be seen. Let's look at the charts together. Now we have some great guests. I'm super excited to have Peter Brandt join us on the show today. Excited to hear his take on what we're seeing. Tomorrow we have Ryan Dietrich from LPL Financial coming back on the show. Next week on Tuesday we have Keith Fitzgerald from the Fitzgerald Group here in the Seattle area. On Wednesday the 24th. Tim Tashler from Sprott Global going to be joining us. So some wonderful guests. I feel very fortunate, very blessed with the quality of expertise represented by some of the people coming through the show. So a lot of great guests to help us navigate these markets together. Let's continue on to our market recap. As I mentioned, the S&P essentially finishing flat today. So, directionally, you really didn't make any progress. We talked last week about the series of digestion days, sort of those sort of sideways choppy, didn't really make a lot of headway either way. It's more processing what we've done. It's the illustration of really a market in equilibrium, right? Where you sort of have buyers and sellers in the end netting out to the same level. So when we have an unchanged day on the S&P 500, neither buyers or sellers are in control. Again, just hypothetically based on this 1 day's trading, we're sort of even. Now, that's not the case all around. So the NASDAQ down today, the NASDAQ 100 down over 0.5%. Mid caps, small caps, same situation, all down. The S&P 100, one of the few that's actually positive. The Dow as well, up about 1/3%. So sort of mega cap over everything else overall today. The VIX actually back down, back below 22 now. Looking at some other asset classes, bond prices have been on the struggle bus recently, but recovering a little bit today, up about 2/3%, with the TLT getting above 145 today. Yields around 1.3% on the 10-year. Looking at other asset classes, sort of a mixed bag on precious metals. You had gold down, you had silver up a little bit. The uptrend in commodities we've talked about, and interestingly, the DBC had this huge rally yesterday. The afternoon session was resilient, opened much lower this morning, but actually finished more on the positive. So this persistent uptrend in energy has continued. The XLE, the number one out of the 11 S&P sectors today, similar to what we've seen recently. So overall, some strength. Cryptocurrencies overall, by the 10 that we tracked, 10 of the more liquid coins, all up today, with Bitcoin up 6%. Bitcoin closing above 52,000 for the first time. Over the weekend, got above 50 or touched 50,000 here into yesterday, and now really pushing further and further onward and ever upward, as we might say. looking at some of the crypto charts. The S&P chart for me has not changed a ton. And if you look at the last 7 or 8 trading sessions, really haven't gone anywhere. You've had a couple days where you finished, opened at the lows of the day, closed more toward the highs of the day. That's certainly more indicative of a bullish tape overall in the short term. But if you take a step back and just look directionally, the long-term uptrend remains in place as long as we keep making higher highs, which we did again yesterday. We keep making higher lows as we've done recently. Overall, the uptrend is in place. Having said that, right, we're off a little bit from yesterday, and I think the trend in the last couple of days has certainly been flat. You've had a lot of what I'd call digestion days, not a real big directional movement. Things like a doji candle, which we've seen a couple of last week, which overall indicate indecision or indicate an equilibrium of buyers and sellers, right? You open at one point, you really don't get anywhere by the close. You sort of chopped around and made a lot of noise, but the directional trend has not evolved. Now, as the market has been going higher, you've been having the situation of momentum lessening in each of those upswings. So the push higher the first week in January, the push higher in mid-January, the push higher in mid-February, each one of those has been met by a lesser amount of momentum measured by the RSI. And that is more, again, it sort of illustrates, waning momentum, right? Sort of the later stages of a bull market, you have some divergences that pop up where the price goes higher, but the momentum sort of coming off a bit. And I'm curious, we're going to talk a little bit later about some of the China ETFs and elsewhere, and I think some of the situations you could be seeing on something like the FXI. It's still really too early to declare this a bearish divergence, in my opinion, because you've had the peak in January, you've moved to another subsequent peak now with the FXI closing above 54 today for the first time. We see the momentum is much lower than what is in mid-January. Now, it's too early to declare this a divergence until you have a subsequent top, until you pull back and you can confirm where the top was in price versus the top was where the top was in the momentum. I think it's sort of a common rookie mistake is you see a market breaking out and the momentum's not quite as high and you go, oh, it's a divergence. It's not really, you can't really say that until the second top is actually in place. So I think it's still early on, but it's certainly something that's on my radar. If you look back at an example here in January, see that with the FXI, higher highs in price and lower peaks in RSI. That really doesn't become clear until you get sort of that sell-off off the highs, and then you can confirm, yes, that was definitely a divergence with lower momentum on the second peak versus the first one. But on a lot of these charts that have gone up, I think you're seeing some similar types of patterns. The XLF is another one, right? So breaking to new highs. Chart of JP Morgan looks like this. Chart of Berkshire Hathaway looks kind of like this as well. We have this break to new swing highs. That's pretty nice after the pullback to the ascending 50-day moving average. The RSI is lower than it was back here. But again, until you get a confirmed peak, the second peak, you can't really say that's a bullish divergence just yet. So don't be one of those people that does a premature bearish divergence call. Wait until you have the confirmation of the secondary top to confirm what that pattern is telling you. And again, what that says at this point is that the momentum is improving as the price is going up, which is pretty much normally what you might expect. We hit on some of those things. Let's look at some other quick themes here as we wrap up our market recap. Energy, as I mentioned, was number one, up 1.5%. So that emergence in energy, really the reemergence in energy is very real. We talked about this yesterday. I think it was one of our 3 and 3 charts. Just looking at this, cup and handle like pattern. I'm seeing a number of these cup and handle patterns, which is where you have a big sort of rounded basing pattern or rounded bottom, you might call this, and then a shallower pullback here just beautifully to the ascending 50-day moving average. We've now broken above the neckline, which is what you call this connection of the interim highs there from the two sides. This is the sort of the handle of the cup, and now we've broken above it. And a classic way to measure that is look at the height of this pattern and project that forward. So if you do that, that gets up into like the upper 60s on the XLE. And I don't know if that's a near-term objective. That seems a little excessive. You certainly could get there over time, over a series of months. You could absolutely get up into those levels. But what it basically tells you is the broader the base, the higher in space, the longer time this has taken, the bigger the basing pattern. When you do break out of it, which we've now, I think, confirmed having done, it basically says the uptrend is in pretty decent shape. And the XLF, you've seen a similar pattern, that rounded bottom, the shallower pullback and the break higher. So some of those cyclical sectors, I think you're seeing a reemergence in those places. What underperformed today, technology, was actually worst of the breed. We've talked about the long-term trend in technology, and again, I don't think that picture has. Whoops, that's the same chart we looked at. XOK. I don't think that's changed a ton. It's certainly down a bit today. But overall, I think the pattern with technology is a story of long-term relative strength. And when you look at the multi-year trend in the XOK, this is why technology, this is why semiconductors in general seem like a decent long-term play, because of the persistent uptrend and the persistent strength and relative strength in both up and down cycles. It's interesting to know, because some of the semiconductor stocks down a good bit today. Semiconductors in the form of the SMH, not a ton, down about 2%, but some stocks within the space down a little more. Now, what concerns me about the chart of semiconductors, if you visualize in your mind the chart of the FXI, the chart of the XLF that we just looked at, and you saw how we had the uptrend, we had not established a secondary high, and we had the lower RSI. You're arguably with semiconductors actually confirming that bearish divergence this week. We'll have to see if we get enough of a pullback to really make this feel like a second peak. But here you potentially have a higher peak in price, a lower peak in RSI, classic bearish divergence. And so, again, looking to see whether or not we get follow through, I think that could be an indication. When I think of my bull market top playbook, one of them is you get a series of bull market or a series of bearish divergences that are validated, that are confirmed. Semiconductors might be one to watch in the short term to see if we get that confirmation. We need to take a quick commercial break. Back with my guest, Peter Brandt. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure to have you join us every weekday after the close for our show. As a reminder, we love to hear from you, in particular, questions that are coming up as you analyze your charts of interest. You can get questions to us one of three ways. First, via email, thefinalbar@StockCharts.com. Number two, on our Twitter feed, @FinalBarSCTV. And third, just put a comment below the video you might be watching on YouTube. We'll capture all of those questions. We'll do another mailbag segment at the end of this week on Friday's show. We'll love to answer one of your questions on the air. I want to welcome on my guest, Peter Brandt. Peter's the founder of Factor LLC. Peter, I followed you in your work. I'm so appreciative of all that you've done to give back and educate those around you. And welcome to the show.
Hey, thank you, David. And I love that. Longer the base, higher the space. Those that follow me on Twitter should be looking for that. I'm going to pull that one out of the bag, very often.
I'm going to check "Teach Peter Brandt a Trader Maxim" off my bucket list. That feels pretty good. So thank you for that gift. Let's get to your charts. We're starting with cryptocurrencies. Obviously, cryptocurrencies in general have broadly been expanding. Bitcoin, continuing to accelerate to the upside. How are you looking at this space right now?
Well, yeah, I mean, that's of course in the news. Everybody's talking about it. It's on headlines. It's on magazine covers. I wanted just to show a big picture. We get so locked down in the short term, what it did today, what it's doing this week, that we lose track of always stepping back and looking at the forest before we examine the trees. I just want to point out something here, David. It is rare for an advance in the market to go parabolic. Parabolic advances hardly ever happen. And when they do happen, it's normally on a arithmetic chart. You can see one, for instance, on Amazon. You can see a parabolic advance. To get a parabolic advance on a log chart, that's generational. And here we have in Bitcoin 3 parabolic advances in the course of the last 10 years. And if you charted, back even to 2008, 2009, you'd see even a 4th parabolic advance. That just doesn't happen. I mean, that's historic. And so we're in a parabolic advance in Bitcoin. And, that means hang on to the rail. We're off to the races. I mean, that's volatility in all capital letters, and that's where we are right now. Keep in mind, in the 2015 to 17 bull market Bitcoin, we had 9 corrections of 30% or greater. We've only had one so far in this current parabolic advance. And so we could have some swings along the way, but this looks to me as if we're probably only halfway through this parabolic advance. And so 50,000 does not surprise me. And, 100,000, quite frankly, would not surprise me either.
No, there have been a lot of comparisons, Peter, made between something like Bitcoin and gold, right? And looking at the relationship, how they might compare to each other. What are you seeing on the chart? This is gold versus the euro here.
Yeah, I mean, I see a top. I mean, it's a classic Edwards and McGee Schabacher left shoulder head, right shoulder neckline, break the trend line. That chart's not updated, but we really sliced through that neckline today. This looks to me as if the gold market is in trouble. Of course, we have major commercial commitment of trader short position. That's not shown on the chart, but this looks to me to be a market that's got some serious worries ahead of it. And at least if I'm parking my money in the euro currency, I don't want to be long gold at this point. I want to have brought it back into my fiat currency, because it looks like, quite frankly, the euro currency is going to gain on gold. Gold is going to lose on the euro currency.
Now, your final chart, Peter, is looking at interest rates and financials, as we mentioned earlier in the show, continuing to just break out. JP Morgan, others breaking to new highs, breaking out of bases. It certainly speaks to the yield curve and interest rates. Talk us through your perspective there.
Yeah, well, I mean, this is only the 5-year, but I'm showing it because it really had the most classic bottom in yields. It's a yield chart, but it shows a head and shoulders bottom in the 5-year. We see the left shoulder back in March, and head back in January. Then we had the head in April. Now we're actually breaking through that neckline, and we've been in a move to lower yields since 1982, 1983. We're almost 40 years into this trend in lower yields. I think that we've seen the bottom in yields. Anybody that missed the bottom to get a mortgage, you're not going to see the yields that were available here just a few months ago. And so if you look at even the 10-year or 30-year, it's a more dramatic bottom. So I think it's safe to say that the U.S. has seen the lows in interest rates, and we're going to trend to higher interest rates. I mean, how much higher? Who knows? I remember in 1983 taking out a 30-year mortgage at 14%. We're obviously not going back there, but nevertheless, we've seen as low interest rates as we're going to see, perhaps for a generation or more in the U.S.
Yeah. We only have about 30 seconds left, Peter, but I'd love to talk just briefly. When you think about the broad equity environment, the S&P making another all-time high in the last week after other weeks of doing so. Overall, I mean, are you feeling more as in long and strong we continue to push higher? Are you thinking there's downside potential? What are you using to sort of figure out which is which?
Well, look at your chart. Look at the RSI. We have potentially a triple non-confirmation between price and RSI. One, two, three. We've got a divergence there, a triple divergence. And so, that kind of makes the hair on the back of my neck stand up and say, whoa, I want to know where the exit door is. I want to be long. I want to own it, but I want to know where the exit door in the theater is.
I love that take, Peter. It is so good to have you on. I appreciate you so much giving us some time, giving us some big picture perspective. Stay safe. We'll talk to you again soon. All right.
Yep. Thanks, David.
That's Peter Brandt. Peter's the founder of Factor LLC. I should note we interviewed Peter recently. We have our second season of Behind the Charts coming up very soon. We're producing that up, and we'll have it ready for you in the next couple of weeks. And one of our first conversations was with Peter Brandt. It was a fascinating conversation, and I wish we could have done it for 10 times as long. Peter's just a fountain of market wisdom and just thinking about how you think as a trader. I learned a lot just from talking with him and picking his brain a bit. So I think you're really going to enjoy that coming up very soon, called Behind the Charts, our season 2 of that series. Let's continue on with the show. Our next segment is called ETFs Engage. This is our attempt to regularly look at the ETF landscape, focus on one particular piece, and just talk about some of the components. I found, ETFs overall are fantastic for individual investors because they give you access. They give you another set of levers to pull. So if you see a particular pattern, you see a particular theme, particular idea, you have more options now than ever to express that in your portfolio in some way. And so it always comes down to, well, what ETF should I choose? Let's say, for example, the example we're going to go through today is China. Let's say I see China breaking out. I want to participate in that. What should I do? There are a number of different ways you can actually do that. And so I found a lot of times it's about understanding underneath the hood, what do these ETFs actually represent, and make sure that you understand the exposure that you're getting. I should know we rarely have time to go through some of the due diligence things, but as a reminder, if you're looking at an ETF, it's always really helpful to look at assets under management, to look at expense ratios, to look at the buy sell spread, or the average spread between the bid and the ask, because all of those can impact liquidity or impact how easy it is to enter and exit positions. And it's rarely something we have time to get into. I hope you're taking the time to focus on those things before you make a decision on one of these. But what we want to do is just talk structurally about some of the differences. So, commonly when we look at China, we talk about the FXI, which is the iShares China Large Cap ETF. There are a number of ETFs. There are 4 of them we'll talk about here very briefly. The FXI, another iShares ETF called MCHI, the EWH, which is a Hong Kong ETF, and then ASHR, which is an A-shares ETF. These are just some of the many, many ETFs you can obviously use to get exposure to some part of the Chinese markets. Let's talk just a little bit about how these are related. The FXI is usually the main one I talk about. Because it's fairly liquid, assets under management over 4 billion. It's been around for a little while, and so I think it's a pretty decent representation of the Chinese equity market. What we talked about most recently are what are called accelerated trend lines. If you take the low in March, connect that to the low in September, then if you look here in December, we're nowhere near that trend line supports. You draw another trend line with an accelerated or an increased slope to connect these most recent two. And then you can see we've gotten pretty far away from that. And we call that accelerating trend lines, where you basically keep increasing the slope. This is not characteristic of a slow and steady, consistent uptrend. That's if a trend line just continues to get tested and tested. That tells you the trend line's in place. This looks suspiciously like Peter Brandt's chart of Bitcoin as I'm looking at it, with sort of more of an exponential or parabolic rise, where the slope keeps increasing and increasing. That's usually not the sign of it. I mean, it's by definition not a slow and steady uptrend, but an accelerating uptrend, a trend that's getting more and more of momentum to the upside. And that on its own is not a bad thing. I think on the left side of a big move higher, there's a lot of money to be made, to be honest with you, on charts that are going higher. So I would slip into trend following mode more than anything, but it's worth following that last trend line that you drew. And if and when that steepest one breaks, that's when you revisit and determine, how comfortable you are with risk and with potential reward and all of that. So the FXI is an iShares ETF, and basically mixes a couple different things. It has what are called H shares, which are Chinese companies listed in Hong Kong. What it does not include are things like A shares. A shares are mainland listed stocks that are not traded outside of China, and traditionally have only been accessible by Chinese citizens, by local Chinese investors who would be able to access their local market in Shanghai or Shenzhen. That's changed now, and I think most investors have the ability to access in other parts of the Chinese market that they had not before. So this represents a subset, and it's really more shares that are listed outside of China. Second one, which we'll talk about, is MCHI, and this is another one. It's an iShares MSCI China ETF. So the big difference there is that this is a pretty broad index. It's a cap-weighted index. A little more, it's about $7.5 billion under management, but it's really it has a little less holdings in terms of some of the other ETFs, but provides a pretty broad exposure, I would say, to the Chinese market overall. The third one is EWH. And this is this one. So this is one of the ETFs that I've certainly followed for a long time. This is a Hong Kong ETF, so it only deals with shares that are listed, what are called H shares, shares that are traded in Hong Kong. So what happens is with all 3 of those, you'll see some different patterns that emerge, and it's less at times it can be representing what's happening overall with Chinese stocks, but a lot of times it also represents the construction of these particular ETFs. So, for example, something like let's see, MCHI, some of the biggest holdings are things you probably know: Tencent, Alibaba, JD.com, Baidu, NetEase, Ping An Insurance Company. These are some of the largest holdings in MCHI. But if you go to another ETF, let's say, let's see, FXI, for example, no, that's actually pretty similar. A shares, maybe the ASHR, which we'll show here. If you look at these ETF, it's things like China Merchants, it's Kuaichao, it's Medea Group, Jiangsu, and some other companies that you're probably not familiar with, because these are not stocks that are traded outside of mainland China. They're really only traded in the A-share market. So ASHR actually is giving you exposure particular to the locally traded Chinese stocks. So what happens is, if you look at each of these ETFs, the correlation's relatively high because they're looking at the same market, but they're going to differ, and depending on what's driving it, because of the construction, because of the weighting. So another thing to look at is the concentration, how much they're focused on the top 10 holdings, top 50 holdings, something like that, to get a sense of how they're related. What I generally do, just to save time, is focus on one of these, and we usually look at the FXI when I'm talking about a particular when I'm talking about China, just generally, to talk about the overall movement in the market. But I wanted to have this segment to remind you that there are other ways, there are different levers that you can pull. They will have different exposures, so please make sure that you dig a little deeper and look at things like expenses, look at things like assets under management, but also the bets, the sector bets. Some of these will have different sector allocations, and that can certainly be part of the return profile that you are signing up for, whether or not you realize it. We need to wrap up the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the shape of the yield curve. My guest, Peter Brandt, had a great chart of yields, and I have to agree with him. If you've been following the show, we've talked about the 10-year and just increasing. I've now heard people talking about 2% plus on the 10-year with a straight face as a legitimate upside target. And this is when, not too long ago, we're at 0.5% or something on the 10-year. So that's certainly increasing. The chart I wanted to show here is looking at the shape of the yield curve. So this is the yield on the 10-year bond versus the yield on the 2-year note. And if you look, you can see how this is increasing. This is coming off of essentially these levels being even in the second half of 2019. Since then, you can see this increasing, the steepening of the yield curve. If you think of the yield curve as a surface from short to long term, you can think of it, the slope of this increasing, and what that generally means. It generally tends to be pretty decent for stocks. It also tends to be pretty good for financial stocks, because that's how a bank essentially would start to make money. So increasing yields, steepening yield curve, good for financial. So that breakout in the XLF makes a lot of sense. Chart number 2 is looking at new highs and new lows. We track this on the NYSE in the top panel, and then the S&P 500 in the bottom panel. This is not updated yet for today's trading. I would expect maybe a little bit less, given that a lot of stocks pulled back a bit today. But overall, you can see this general increase. And going into the end of January, you can see how it was less and less stocks making new highs. And that divergence, I think, was a question mark of sorts. We pulled back not too long after, but bounced off of 3,700, making new highs. And we can see, once again, a healthy increase in the number of new highs. 81 stocks on the S&P 500 made a new 52-week high yesterday. That's in line with early January, as we're pushing out of the end of last year and pushing to new highs. So overall, using that, broad advance, strong, and plenty of stocking making new highs, which is encouraging. In terms of what stocks in particular are making new highs, I'll highlight one of them, Freeport-McMoRan, FCX. I forget, and forgive me, whichever guest recently brought up FCX. I've talked about this with a number of people over the last couple months, but you can see the improving price, the pullback to the 50-day, the rotation higher, the new 52-week high, again today, up almost 4%. What I also love more than that is the relative strength, making a new 52-week high as well. So price breaking out, relative strength breaking out, is a strong uptrend that is outperforming others. And that's usually a pretty good sign. That's our show for today. Thank you so much for joining us. Thanks to Peter Brandt joining us as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.